right now. They're sharing.
Sorry, I want to get this recorded for you. You want that recorded, right?
Yes, please. Thank you.
Okay.
Thank you. Thank you.
Yep.
So I know my team is right now texting and individually emailing people who would want this link and to be on tonight. So my apologies for technical difficulties, but here we go. For the third time, we're here today to learn about 2023, the market, real estate, tax laws, the opportunities of what is there in 2023, because there's a lot of news out there. We're just trying to figure out from market experts. Everyone that's on is an expert in their specific niche. And that's what we want to do. We want to hear from the best of the best. And that way we know exactly, what happened last year in 2022, what's happening right now. And we could try to make some projections for the future. And that way we could all be in the know and potentially make some money in 2023, or at least preserve our wealth in 2023. Okay, so let's get right into it. Let me start sharing my screen. And we're running behind, obviously, because of the technical difficulties that we had. So we'll just zoom through it. Here's an outline. So we're gonna, Dr. Fogel isn't available right now. He might be able to jump on later, but we had him going on at 6:33. So first up is Amanda Hahn. Amanda Hahn is an awesome CPA and real estate investor. She's helped countless investors across the nation supercharge and wealth build through proactive tax planning. I knew about Amanda because I read her book. She wrote an awesome book about real estate investing. I bought it, read it, and man, she just has a wealth of knowledge, and she has really rich clients. And that's what we want. We want to learn from people who deal with a lot of really rich people, because we want to do what they're doing. That way we could grow our wealth too. So Amanda, welcome. Thank you for joining us today. And we're going to give you co-hosting access, but I know I didn't properly introduce you and give you all the praise that you deserve. But is there anything that you want to share with us about yourself before you teach us something?
No, I'm excited to be here, guys. Like Voltaire said, my name's Amanda Hahn, and I describe myself as a CPA by day and real estate investor by night. So not only am I a CPA who works with real estate investors, I am a real estate investor like a lot of you. So I'm really excited to be here to listen to the state of the market. I know quite a bit about tax changes in the tax world, but definitely not an expert on market timing and the lending changes. So I'm here to share some knowledge on taxes, as well as to learn from some of our other speakers today too. So really excited to be. I think I only have 10 minutes, so I'm going to dive in. I know we're a little bit behind schedule.
Thank you. And by the way, I think that's the way that most rich people start off, is real estate's a side hustle for them. Just like me, I was a realtor, still am a realtor. My side hustle, nights and weekends, is real estate investing. And I think we all need to have the mentality that Amanda has. So thanks for sharing about that part about yourself.
So my company's name is called Keystone CPA, and what we do is we work with real estate investors nationwide on how to use real estate to save on taxes. So like Voltaire said, I have a lot of clients that are very high net worth, but I also have clients who are newer investors as well, starting out in real estate, but mainly people who are looking to aggressively build their portfolio. But why is taxes important? And the reason is because studies have shown that taxes is actually one of our biggest expenses. So believe it or not, taxfoundation.org came out with the research. They do a research every year, still holds true even to the most recently filed tax return, that Americans lose more money to taxes than we do in food, clothing, and housing combined every year. So pretty amazing, right? Because at least, for us real estate investors, we all know housing is a big cost, but to understand that taxes is costing more than all three of those things. And really, we're looking at not just income taxes. I think a lot of us are always looking at income tax, federal income tax, but for those of us in California, there's also state income taxes. And of course, property taxes on all of our real estate, payroll taxes into Social Security and Medicare, sales tax whenever we go to Costco or fill up our gas. So you can see how those add up pretty quickly. And the reason it's really important to do tax planning to save on taxes is because it's not just about the money saved in tax, it's about what you can do with that money, right? So if we can save $10,000, or let's say we can save $20,000 in taxes in 1 or a couple years, that could be a down payment on $100,000 worth of real estate, right? Especially for us as real estate investors, we love the concept of leverage. When Voltaire and I were talking previously, said, okay, what should we talk about? We're talking mainly about tax changes. My job actually today is fairly easy. We don't have a whole lot of tax changes. We have one major one, which I'll talk about in a moment. But really, no news has been good news for us as real estate investors. So, if you've been following the news media for the last 2 years, there's been a lot of talk about proposed tax changes to take away the unfair advantages of real estate investors. So, it talks about limiting 1031 exchange, where we won't be able to defer our taxes when we sell a property. That never came to fruition. Currently, there's no talks of that coming back, but you never know. Every administration, every election, this likes to pop back up. But for now, no limits, no changes. You sell property for $10 million gain, you can do a 1031. You sell it for $1,000 gain, you can do a 1031 exchange. Also, another one that was possibly on the chopping block was the qualified business income deduction. Hopefully, for those of you who are, more full-time real estate, you've heard about this already. If you haven't, this basically was a benefit that came out a couple years ago, where up to the first 20% of our taxable income from real estate could be tax-free. So taxed at 0%. Meaning, if you made $100, the first 20 you're not paying taxes on it. The other 80 is what you pay taxes on. So this applies to all types of real estate income. This is one of those loopholes that, for example, my CPA practice, CPA income, it doesn't qualify typically, and there's a lot of limitations and things like that. But a lot more lenient and flexible for real estate. So when it comes to real estate income that's eligible for this 20% tax-free, it's still, realtor commissions, rental income, if you're doing fix and flip, wholesale, property management income, basically all types of real estate income. To the extent you have taxable income, it's possible to get up to the first 20% tax-free. And again, this is not a change per se. It's a benefit that we had for the last 2 years or so. Last couple years was supposed to be taken away, but it was not taken away. So we still get to utilize that.
And the 20%, a lot of people don't know that. So if you own an apartment building and it shoots out $100,000 of profit in 1 year, that means the first 20,000 is tax-free,
Yeah.
which is crazy because the tax laws are made so that you buy and own real estate, right? The government wants you to do that. They bait you into buying real estate.
We call it incentivize.
Incentivize.
Incentivize. They want you to do those types of things, right? So yeah, so we still get to that. And then just one thing I want to talk about, that 20% tax-free treatment. There are limitations based on how much income you make and things like that, but it's called qualified business income deduction. But don't let the name mislead you. You don't have to have a business entity. So even if you have your rentals in your personal name, or you have your commissions in your personal name, it's possible for you to get this benefit. So we get it regardless of whether or not we have legal entities. Okay, it's based on the type of income that you're generating, and again, most real estate income would be eligible for that. Speaking of legal entities, of course, a common misconception people think is like that you can only write off certain things if you have a legal entity. So if it's for your rental properties, whether it's like a home office, your car expenses, those types of stuff are eligible deductions for all of us here as investors, regardless of whether you have a legal entity or not. So especially for the newer investors, if you're just starting out, you've paid for some real estate memberships, bought some books, traveled to some conferences, you can take those deductions regardless of whether you have an entity or not. Especially for those of us in California, legal entities are not just expensive to form, but expensive to maintain as well. Every year, we make what I call a donation or a fee to Franchise Tax Board, at least $800 minimum per entity. So before you run out and work with a Nevada lawyer to set up a bunch of complex entities, talk to your California tax advisor, so you understand what the costs are associated with it. And so these are all just kind of common things to keep in mind. Now, the one change that is happening for 2023 is there is a change in bonus depreciation. So I'm assuming most of you have not filed your 2022 tax returns yet. IRS is not open yet. For 2022, we had what was called 100% bonus depreciation. So if you're a landlord and you bought new appliances, new furnishings for your rental properties, you could take 100% bonus depreciation on those. The change for 2023 is new assets, new rentals and service in 2023. That bonus depreciation goes from 100% down to 80%. Still really, really great. You still get a huge bonus. It's just instead of 100% immediately, we write off 80% now. The remaining 20%, we get to write those off still over time. So still extremely beneficial to invest in real estate this year. Next year in 2024, it goes down by another 20% haircut. So the sooner we invest in real estate, the better it is.
So that's huge. And just so, my personal experience is I made a lot of money or saved a lot of money with bonus depreciation. I'm talking about hundreds of thousands. I mean, I don't know how much, it was a lot. And so that's, she doesn't have the time right now to like teach you about it and how it works, but definitely write it down, research it, because that's one of a huge benefit of being a real estate investor. Okay. And what else, Amanda? Anything else?
Yeah. And the last thing I want to talk about in terms of just talking about kind of market predictions. I don't have, again, I am not qualified to talk about market predictions by any means. But, I've been around real estate for a long time and actually started investing in real estate myself in 2010, which was the down market at the time. And I think what we're seeing right now with the kind of uncertainty in the interest rate or the clear rise in interest rate, what I expect to see is probably a lot more creative financing. Saw a lot of creative financing deals back in 2010 when interest, when the market was in flux, but now with the higher interest rate, I'm already starting to see more creative financing deals like seller financing. So where the seller carries the note, or subject to deals where you buy a property subject to the existing financing if the seller is at a 2%, 3% interest rate. So just so you guys know, from a buyer's perspective, there's a lot of great benefits to that because you are the owner of the property. So you do get depreciation benefits, write-off benefits, just like a traditional loan. From a seller's perspective, there's also tax benefits when they do seller financing because they get to defer their taxes on the transaction. So sort of like a win-win for both people. In terms of forward looking, I think that's something I expect to see a lot more, at least in the near future, in terms of just more creative financing deals. So I can take any questions if we have time.
Yeah. What questions you guys have for someone asked for your phone number? Or your contact info, if you could type it into the box. Please.
Yes, I will. The best place to find me is my website is keystonecpa.com, KEYSTONECPA. I have a lot of free downloadable information there. Like Voltaire said, if what we talked about is like super new, you can check out more information on our website. And I'm also on social media. You can find me on Instagram, Amanda Han CPA, trying to give snippets of tax strategies on a daily basis.
Dope. And yeah, and by the way, if you follow her on IG, she's really good with giving a bunch of like a lot of really golden nuggets within like a 60-second reel. So if you follow her, and I mean, during vacation, that's all I did was I went on her page. Like I had it in my calendar. I'm like, okay, watch her page for an hour. And I just went through and I just watched all her reels and took down a bunch of notes about my tax strategy this year. So it's good.
Yes. And then Voltaire DMs me, but I'm like, you could just email and call me.
Yeah, exactly. So any questions for Amanda before she jumps out?
I think somebody had typed in about opportunity zone. So right now, no changes in opportunity zone. That was another one of those proposals where they wanted to kind of define more what that is or where the requirements of being opportunity zone. But So far, not a lot of changes. Just so for you guys who don't know, opportunity zone is the ability for you to defer capital gains taxes. So it's, whether you sell a rental property and you didn't do a 1031 exchange, or you failed the 1031 exchange, you can reinvest that money into an opportunity zone asset and defer your capital gains taxes. In practice, for real estate investors, when they sell real estate, they typically 1031 exchange into other real estate. Where I see the opportunity zone mostly is people selling stocks and moving into real estate because they can't 1031 exchange stocks. So these are typically, high tech people, or just people who made a lot of money in stocks or crypto back when that was profitable, who want to get into real estate without paying the taxes. They take the money, invest in opportunity zones. That's another, 8-hour topic we can talk about too.
Yeah, that's interesting to bring that up because a lot of people did lose money on crypto and stocks. So there is a way to kind of make that work for you some way through taxes.
Yeah,
Okay.
for sure. It's what we consider loss harvesting. So if you had losses from crypto, from stocks, harvest those losses, because at some point you might sell your real estate for a gain. These losses from the stocks and crypto can help you offset those gains in the future.
Okay, that's really good to know, I think, for a lot of people, because a lot of people just feel, they bought crypto at 60,000, it went down to 20,000, and they're just taking that L, but you don't have to just take that L. Take it to someone who's qualified to advise you on your taxes, like Amanda, and then from there you could turn that L into a W, right?
Yeah. Yep.
Cool. I like that.
I had a quick question.
Yes, John.
So I just wanted to confirm that wash sale rules are not applicable for cryptocurrencies, correct? So you could sell it and then re-enter that same position, tax loss harvest, and then you wouldn't have to wait the 30 days before, 30 days after, right?
Yep, exactly. It's just a transaction. I sell this crypto, get a loss, buy it back exactly the next day. I still get the tax benefit of writing it off. Yep.
Cool. Awesome question. And then we have one last question. Do you recommend a living trust or a family versus a family trust for tax purposes?
It's really going to depend on the situation. The living trust, I recommend that for anybody who has, who's married and or has kids. The purpose of the living trust is to make sure that if something were to happen to you, that your assets are dispersed the way you, according to your wishes, to your beneficiaries, without having to get the government involved, like going through probate and things like that. So yeah, it's pretty much for most people very cost effective to set up and maintain. Family trust is a little bit more complicated. Is when you're shifting assets right now to other family members. Usually we look at this when people have a pretty good amount of net worth, so maybe over $11 million per person, is when you start to use a family trust to shift assets outside of your estate. So they're just kind of different, two different types of products for different net worth, pretty much.
That's a really good question. I like that. Okay, cool. Well, I appreciate that answer and your time, Amanda. We're gonna move on just for the sake of time purposes, but I took my notes. I hope everybody else took theirs too. And if you need Amanda, just go to her website and she'll hook you up.
Thank you.
Yeah, my pleasure. Thank you. All right. So Dr. Fogel, I know you had to leave, come back, and you have to leave again. So we're gonna bring you on next. And yeah, so thanks for your time here. Let me just share a quick bio. Okay, so Dr. Fogel is an internationally recognized scientist, speaker, and engineer. David has served as a director of research in the financial service industries for under a decade. He received his PhD and Master of Science in Engineering from University of California, San Diego, as well as a Bachelor of Science in Mathematics from the University of California, Santa Barbara. So really smart dude. I could have just said that, huh? Really smart dude. That would have been a proper introduction.
I appreciate that. Thank you.
Yeah, no, thank you. So, Dr. Fogel, in the past, you've enlightened us with a technical analysis, and that's what you're going to share with us today. And if you could just break it down for everyone and make it simple on us because there's a lot of lines there.
Yeah, there are a lot of lines here, but let's go through it. Okay, so this is a technical chart of the S&P 500 using Thinkorswim. And I go through this same presentation analysis, of course, not the same because every day is a new day, but every Tuesday at ATS, we have a Zoominar, and I'm on doing the same function that we're doing right now. So with that as an intro, let's look and see what we've got. We've got green bars and we've got red bars. Green bar is an up day. A red bar like today is a down. This is down 76 basis points or 0.76% today. Broadly, we can see from the beginning of last year, we've been in a down channel on the S&P 500, and a down channel just means that we're cycling between a top and a bottom. The top has been touched 4 different times, 1, 2, 3, 4 different times. And the more times you touch the top line, the stronger we call that as a resistance line. So I have a pretty bold line here of resistance. We were up against it 3 days ago. I could have had some good news for you that we are breaking out and getting towards a bull market. I do not have that news for you today. Tuesday, I was optimistic. Thursday, a little less so, but let's see where we are on the bottom side. So the bottom of this channel is here, and unfortunately, we haven't tested that. The bottom looks to be around here at 34.91. So we're in a bear market. Bear market means we're more than 20% off of the most recent high. And I go by the actual absolute extreme of a day rather than the close of the day. So the extreme of this day, 34.91.58, to get 20% higher than that, we'd have to get back to this red arrow. We entered a bear market when we crossed this red arrow. We've been in a bear market ever since because we never got 20% higher than that. But then we went lower than that. So we set a new low. Because of that, we have a lower high to get back to a bull market. Psychologically, people are generally more optimistic when we say we're in a bull market than when we're in a bear market, especially on the S&P 500. We have niche markets that are bull and bear markets all the time. And in fact, you could analyze individual equities or individual real estate holdings, in your case, as being in bull or bear markets too. But when we have 500 of the biggest companies in America, and they're all moving in a particular direction of being a bull market or a bear market, people tend to view that with more momentum and more insight, I think.
So we entered a bull market, and I think it was sometime last year in May-ish.
Bear market.
A bear market. So what does that mean for us, for regular consumers, property owners? Does it mean anything at all?
It does. So to me, it means generally investors are going to be more pessimistic. It's like you have a little black rain cloud hovering over your head instead of a bright, starry day with the sun shining. And the same news that comes on a cloudy, rainy day can be interpreted much more negatively than if it comes on a bright, sunny day. And so let's just come back to where we are here, right? So we're testing this resistance. We're coming up against it. We have a couple of other technical indicators here that are important, and I'll go through them in just a minute or two and then kind of summarize it for you. Voltaire, you can get back to your regularly scheduled programming at that point. Sorry, we had our Zoom issues earlier. So this is what we call a MACD, moving average convergence divergence. Anytime the yellow line is above the white line, that's a positive. You can see it's starting to turn down, hasn't quite crossed yet to the downside, but at best that's neutral. Stochastics tell you where you are as a percentage of where you've been. And again, if the yellow line is heading down, that's a negative, and you can see that is a negative. We have the 50-day moving average in yellow, which is climbing. We've got the 200-day average in purple, which is falling. And this is an important other thing that we could get. So I'm going to zoom in here. If we can get this yellow line across the purple line from low to high, that's called a golden cross. Again, more like a bull market, optimistic, sun shining. That's great when the 50-day moving average crosses on top of the 200. So we have quite a few opportunities here, but the main things that have been driving the S&P 500 are the prospects of the Federal Reserve raising interest rates. And as of today, from the site that I follow, with the February 1 meeting coming up, you probably already discussed this, but I'll just mention it from my perspective. The information that I have, about 68.4% chance, based upon those people wagering on it, that the Fed will raise by 25 basis points, 31.6% that they'll do nothing at all. We do have inflation data coming at the end of next week, which is very important for the Fed. So we won't really know about that until the Friday. We have seen contraction in manufacturing. We've seen contraction in retail sales. We have seen a lowering of inflation at the wholesale level. So those are things that would cause the Fed to not raise as much. And currently the S&P stands with a P to E of about 20.25. The long-term average for the P to E for the S&P 500 since the internet is about 22. That's price to earnings ratio if that's inside baseball for somebody. So that's the amount of money people are willing to spend for $1 of earnings. And of course, 20.28 means that we're under the usual value. It means it's a value play to buy right now, but not as much as it was back at 34.91, right? When we were down somewhere around 18 to 19 on the P to E. So I would say at this point, I'm optimistic that we'll get some good inflation data at the end of next week. Things seem to be cooling off a bit. Consumer confidence was down a little bit. And with that, hopefully the Fed will not take too much action. I still am on the camp that they're going to raise 25 basis points on the February 1 meeting. But we don't see these 75 basis point hikes that we've been hearing about and had to experience previously.
And
Happy to take any questions.
Yeah, and obviously, every time they increase the interest rates, that hurts a lot of us in the mortgage business, in the real estate business, in the car business, anything that you finance, really, right? And so, do you feel, from what you're seeing out here, do you feel that there's going to be obviously this rate hike that's coming up, 68% chance? Do you feel there's going to be more rate hikes throughout this year? What do you feel the rest of the year is going to look like?
Yeah, my intuition, and that's all that is at this point, would be that there really isn't much impetus for more rate hikes. This could be the last one for a while. I say that because when we see the Empire State Manufacturing data on Monday contract down to -32, I think it was something like that, and then that's followed up by Philadelphia down also. Let's take that at face value. Let's say that the market is contracting. We are heading into a real recession. We were in one last year that some people said we weren't in, but 2 quarters of down. So we were in one, we got out of it. We're going to probably go back into one. And in that respect, there's not going to be much impetus for the Fed to continue raising when we have, a recession that's in process. They'll probably just let that play out on its own. So that's what I would expect. And we'll see. But of course, if we get the PCE inflation data on Friday of next week, and it says, hey, we're up 0.5%, then that's going to change things radically. I just don't expect that to happen, given that we just saw wholesale inflation down 0.5%.
Got it. Okay, cool.
Of course, wholesale inflation precedes retail inflation. So if wholesale inflation is down 0.5%, we wouldn't be expecting to see retail percentages up like 1%. That wouldn't make much sense.
All right. And we have a question. Do you think the market has bottomed? I'm assuming they're talking about the stock market. Do you think the market has bottomed?
Well, so let's look at this for a second. I think that's a reasonable question. The answer is I do. How confident am I on that? Moderately confident. Could we go back and retest this low? Yeah, if we got bad inflation data and we find that the earnings data that come in February for companies are not as strong as we expect, then we will definitely go back and retest those lows. But if things go according to expectation, I would think that that's probably the low. And we might move in a sideways channel here for a while, but until we get a little bit of good news. Of course, there are other potential things that we need to keep in mind. We still have geopolitical things going on with Russia and Ukraine. We have other things that can always happen in the Middle East. We have things that we don't know whether they're going to happen with China, Taiwan. Any number of things could happen that would send the market in the other direction. But barring those things at this point, I think that 34.91 number is not likely to be revisited unless we get some really poor earnings or really surprising inflation data.
Got it. So you feel that unless we get some surprising data, then we already hit the bottom, basically.
I think that's correct. And the other thing to say is that we've had a higher high from this high and a higher low from that low. So we've already established a bit of an up channel here. If I were going to draw something, I would be drawing it something like this. Right. This is kind of what we're in right now. But we just fell behind it. So now this is the resistance line. But as I say, once we get through that, if we get through that, we'll have a golden cross technical, we'll have MACD up, we'll be through this and breaking this 1 year down channel, and then we'll be in a bull market. So we have 3 things that are pretty substantial technical factors. to say the market's going higher. And with that, we have a sunny day instead of a cloudy day, and people tend to be more optimistic and want to invest. So
Got it.
it's a self-fulfilling prophecy at that point. So I could say earnings data so far have been okay. But we've only begun to see the earnings data really for the quarter. We're still in January.
For sure.
If I remember correctly, I think Microsoft and a few other big companies are coming out, Procter & Gamble, whatever, still. So next week. So we'll just have to
Next week.
check on that. I think so. I think
Yeah,
on Tuesday.
question, I don't know how to put my hand up. I was wondering if I would be able to ask it.
Yeah.
Sure.
So my question is, do you feel that we're going into a deflationary environment from the 9 to 4? And at that point, do you think that we're going to see a double peak in inflation once we do get to the 4? There's a camp that says they're going to not do QE, and that may create inflation to come back, especially when China reversed from their zero COVID policy, and that's going to increase the demand curve. Do you think that we have seen the true peak of inflation, or do you think that we'll see it drop down to 4%, and then with China entering back into the economies of the world, we'll see that spike back up?
Yeah, that's definitely possible. I don't know that I would describe it as deflation, but I think it's definitely possible that we would get to a number and then creep back up. Whether that number is 4, 3, 4.5, or high, we don't know. But I think as China opens up again, they could close just as well again. So anytime you have an authoritarian government, it's hard to know what to expect, right? They could change their mind tomorrow. So yes, that's a risk. But probably, the bigger thing is, what is the American consumer doing? And we're still the biggest market. We still drive almost everything that happens economically in the world, really. So if consumer confidence is increased, if manufacturing goes up instead of down, like we just had, that could be inflationary. Every projection that I've seen has us with an inflation that's above the Fed target of 2% for at least a year to 2 years. Some say longer than that. Some say the Fed should change their target to 3%. That's like defeatist, right? But they might do that too. You never know. So yes, I think what you said is a concern, but that's not my primary concern.
Thank you.
Cool. Thank you. I have a couple of messages here. They're asking if, in regards to investing into the stock market, what are some things that you have in your portfolio that you like in your portfolio, whether it's indexes or companies?
Yeah, I don't think I'm allowed to talk about specific things like that in a setting like this, Altair. So I don't mean to punt on anybody's question, but I think we could talk a little bit about some sectors that have been up in the last year. That's energy and commodities for sure, right? With the exception of gold and other precious metals, which to me still remains surprising, and probably I wouldn't be too surprised if they caught up with the price gains that we've seen in commodities overall. But there has been a pullback in commodities and agriculture. So I think as you see the things that were sensitive to rate hikes, which was technology mainly, things like that are highly levered, then those would be the things that would be benefiting with stopping of rate hikes or a lowering of rates. So that's probably the best advice I mean, it's not really advice, the best comment I can give in an open setting like this.
Of course. Yeah, I understand. Thank you. All right. Well, I appreciate your time. Thank you for joining. Thanks.
Glad I could get back on with you. Yeah.
Yeah, no, we appreciate you. All right. David, we'll talk later. Thanks for your time.
All right. Take care, everybody. Have a good year.
Yeah, you too. All right.
Okay.
All right. So next on the agenda, we have Alfonso Delgadillo. Alfonso, if you could unmute yourself, please. And Alfonso is, am I sharing yet? No, am I? No, here we go. Alfonso's a senior loan officer and a producing branch manager at Point Mortgage. Also, he has been a top producer in San Diego County for the last 7 years, ranked top 1% in the country by Scott Smith Guide, Mortgage Executive Magazine, and National Association of Hispanic Professionals. Alfonso knows his stuff, right? He owns real estate. He's invested in real estate. And he does a lot of deals. And what I like about his knowledge that he's going to share, his experiences, he helps a lot of families. So in helping a lot of families, he sees a lot of scenarios. He sees people's, W-2s. He sees their income fluctuating. I mean, he meets with so many people. So he has a really good gauge on trends and what he's seeing with different families as he's helping them with their mortgage needs. Welcome. Thanks a lot, Alfonso, for being here.
Absolutely, brother. Thank you for having me. It's an honor to be here with you guys today and sharing a little as much as I possibly can.
Cool. Perfect. All right. So you have the floor. Go ahead and share with us what you have in regards to the mortgage market.
Absolutely. Let me see if I'm doing this right. Share this one and then I'll bring up my screen. Can you guys see the presentation there, the slide?
We could see your computer program, a bunch of Excel spreadsheets and stuff.
Okay, hold on. I don't know how to, hold on.
He's really good at loans. Let me just tell you guys,
I'm
really good with loans.
I'm very good with loans.
Alfonso, when you go to share it, it'll ask you what to share. You probably shared your desktop versus your screen. So when you hit the share button, the green share button, take a look at the options. One of them
What I'm gonna do,
highlighted.
Yeah, I need to go here and I'm gonna forward this to, hold on, give me 1 second.
Yeah.
I know what I did. I'm in the remote server, so I gotta get out of the remote. I know what I'm doing.
We might actually have that file, Sedera and Voltaire's emails. Pamela sent it to him.
Okay, hold on, let me see if I have it here.
Yeah, and if you want, I could pull it up from my email.
I think here it is. Hold on, is it this one? Yep,
You got it? All right.
I think I do. Open. Yeah. Open. Sorry. I'm in my desktop and I had to go to the remote server, so I think it's opening here.
It's all good. No worries.
I promise I know how to do loans.
Hey, no pressure, but we're losing people. People are just exiting. No, just playing. I'm joking. just keep going.
So Dara, any way you can share it? Sorry. It's
Okay.
not letting me open it.
Do you want to do it, Voltaire? I don't think that.
Yeah. So who sent it over?
Pamela?
Pam. All right.
And it handles it.
Cool. Got it. All right. Actually, I have his headshot.
She sent it earlier.
Presentation. Here we go. Got it.
Yeah.
Let me open it up. And let me share it here.
And Voltaire's really good at selling houses.
Yeah, for real. I'm like, what happened here?
Yeah.
All right, there we go.
Awesome. So thank you guys so much for having me. So you can go to the slide number 2.
Slideshow.
You want to, and then, yeah. So Voltaire and I talked about today, we want to bring some value and we want to talk about what's happened, in the mortgage business and real estate business and over the last couple of years and what we think in the best of our ability, it's going to happen in 2023, I'm sorry. So what happened was, as you guys all know, rates plummeted in 2020 and 2021 in response to the coronavirus pandemic. So what we saw is by July of 2020, the 30-year fixed rates, dropped to below 3% for the first time. Okay, and they kept falling to a new record low, and the average record low for the interest rate, the 30-year fixed, was 2.65. However, I did do some loans in late 2020 under 2%. I closed actually 2 loans like at 1.875. But the average 30-year fixed mortgage, we saw a new record low now for the history. It's going to be 2.65 average, and that was in January of 21. Okay, now at the 2.625, the monthly cost for 550 then. Today obviously we know that the real estate market, just took off right out of the rates when the rates dropped. Back then you could get a home for $550,000. So I did some research, and you were buying 3-4 bedroom house in January of 2021 for for about $550,000, and that would give you or the consumer in principal and interest payment of $2,160. Now, that was not including the taxes and insurance, but if we go with an entry level, FHA loan, minimum down payment, that payment with taxes was, about $3,100. So, $3,154, including taxes and insurance, right? So now what we're seeing that's happening, if you go to the next slide, Voltaire, yeah. What we see that happened in 2022, the mortgage rate spiked, right? Thank you. I mean, it was thanks to the sharp inflation growth, right? We just heard inflation going up and up and up, and that's where, Dr. Fogel was talking here a minute ago, and, the Fed started raising rates, right? In my personal opinion, Fed's raising rates had never had a direct correlation to mortgage rates. For the first time, we've seen that, though. Every time the interest rates went up, mortgage rates went up as well, right? And that was obviously to slow down all the inflation. Those rates were backed by mortgage-backed stimulus, right, by the Feds. So, according to Freddie Mac, the average 30-year fix jumped last year in 2022 from 3.22 in January to 7.08 by the end of October of last year. Okay, so I truly also believe that we've peaked. The interest rates have definitely peaked. We are now seeing the rates reside and come back down. And now we're seeing rates in the high fives and the low sixes, right? And this is the average interest rate, correct? So rates are starting to come down because of all the new data that we're receiving, okay? So that's what happened last 2 years. If you can go to this next slide for me, Voltaire, appreciate that, okay? Now, what can we expect in the lending and interest rates in 2023, right? I do not have the crystal ball, but this is what I get from the experts that I follow. So mortgage interest rates forecast for January 2023 are expected to, forecast the 30-year fixed mortgage around the 5s to the 6s. Now, we are seeing that already. I was talking to an entry level family yesterday. They want to do a conventional loan, 5% down or FHA. I'm seeing rates 5.75, 5.8. They can pay a couple points or buy down the rate to the low 5s now. So we are seeing, we're seeing the rates that, are in the high 5s, low 6s, over being in the 7.5%. Okay. So experts expect the Federal Reserve ongoing monetary policies to continue to put some upward pressure on the mortgage rates in the coming months. And that's what Dr. Fogel was talking about, right? We're waiting for this data that comes February 1st. We are seeing what's going to happen. I truly believe I'm on his side on this. I think the Feds will raise rates about 0.25%. I am not qualified, but that's just what I get from the experts that I follow as well. Okay, so that's what the rates are going. I don't know, how many of you guys on here are realtors or in the real estate market right now currently, but over the last 10 days, I've definitely seen, Voltaire, an influx of new buyers coming into the market. Where I was talking to a couple business partners over this past few days that we're starting to see multiple offers again, right, on these homes. So, I think we're moving in the right direction when it comes to real estate and mortgage. I think last year was just, rates were 2%, 3% for so long that when they started going up, it was a shock to the consumer, and everything for us in the lending world, right, it kind of came to a halt. Like by the end of May of last year, it was like literally somebody just closed the faucet. It was like, where are all the buyers? Where are all the leads? Everybody was on the fence, thinking the market was going to crash like in 2008, the prices were going to drop 50%. And no matter what we said and did, it was just a big shock, right? And I don't blame them. And quite honestly, I mean, the monthly mortgage payments, when you take a house of $600,000 or $650 from a 2.5 or 3% to 6 or 7, those payments nearly doubled. So affordability became a big issue, and that's what we saw last year. But this is what we're seeing this year. Affordability starting to come back as the rates come back down, and as we see sellers more willing to negotiate and lower the prices a little bit. Okay. Next slide. What programs are available to the home buyers or homeowners, right? Can they get a second loan or a HELOC? And I'm going to talk about those here. So, to the left of the screen, you know, first is FHA, VA, conventional, right? Down payment assistance. These are the most popular loan programs out there right now. But just like, you know, Amanda was talking about earlier, there's also creative financing that we're starting to see because these properties have created a lot of equities, and we're seeing more seller carries. We're starting to see seller financing. But the FHA, VA conventional markets, what's always been the traditional financing out there. And that's what I specialize on. I've been doing this for 19 years. And like Voltaire says, I've been blessed to have partners like Voltaire that trust on me, that believe on me, and to help hundreds of families every single year with their mortgage needs. So a lot of the times those buyers don't have money for a down payment, okay? And here we are, we offer down payment assistance. We know how to do them very, very well. So if you guys know of anybody out there that's looking to buy, I mean, this is a solution, okay? We offer up to 103% financing, which means that we will not only finance 100% of the home, but I can get you guys additional monies to pay for closing costs, okay? Right now, the program that I'm really, really promoting, and I'm super excited to bring up again, it's an FHA, it's a true 100% financing program. It is the only program right now in the market that it's a grant, okay? You do not need perfect credit. All you need is a 620 credit score, and you can get the money. The moment your name gets signed, recorded in the county as you're the new homeowner of this property, that 3.5% assistance, which is the requirement for FHA for down payment, it gets forgiven. Okay, you don't have to pay it back. It's free money. It's phenomenal.
So there's some good programs out there for sure, and there's some equity lines of credit. So tell me about the home equity line of credit market, because I've noticed that there's a lot of people pulling home equity lines of credit. And by the way, the reason why somebody would even want to pull home equity lines of credit, for the most part, or it should be for the reason of making more money, you know, investing into their real estate and making more money. So just we only have a few not even minutes, but seconds. But what's happening with the home equity line of credit market?
You know, it's a great question, and I want to bring it up. They're picking up a lot. Speed is very popular. So with a home equity line of credit, right? What they do, Voltaire, if you see on there, it says 95% CLTV, which means that we can let them borrow up to 95% of what the property is worth. Obviously, if they have a loan for the first mortgage, we combine that with the line of credit, and they're only going to pay on the money that they use. So for example, if they get a line of credit for $100,000, Voltaire, and they only pull $10,000, they only pay them the $10,000. And as they pay it down, the money becomes available, okay? So it's a great program. It's an interest-only loan. It's great for anybody that wants to grow their real estate portfolio, that want to leverage the equity to go buy a condo or a multifamily, right? That's the great program, okay? Now, some people don't like the lines of credit because they're variable, okay? So we have the second option that says home equity loan. So it's a second loan. You borrow $100,000, day one, we give you 100, you pay on the $100,000 you borrow, and it's a fixed interest rate, it's a fixed payment, okay? So these are great vehicles to leverage your equity.
Now, and we'll get to some questions right now, but I just wanted to touch on the home equity line of credit, because I think that's going to be an asset to anyone who actually is able to get a home equity line of credit loan. And then what else do we got? We got some historical data.
So historical data, just like, you know, Dr. Fogel was talking about, here's like historical data, so people know, like, oh my God, the rates are too high. Well, here's high, okay? So Voltaire and I have been on this game for a long time. So, you know, if you see their 1981, you know, or 83, their interest rates were like over 18%, right? So those are the interest rates since 1971 to the end of 2021. I wasn't able to pull a chart for 2022. However, as I mentioned, the interest rate did peak at over 7% in October of last year. But that just tells you guys right there where the interest rates have been, right? So we saw the peak of the real estate market. Why? Because the interest rates fell below the new historical average. So the average since 1971, like Voltaire's highlighting, it's 7.76%. Okay.
Cool.
And then
Thank
the
you.
next slide, it gives you a little bit more data clear right there, exactly, okay? So those are by years what the average interest 30-year mortgage has been for the last, 30, 40 years. So rates in the fives, I know we don't like them, but they're not that bad.
Right. So basically, this chart just shows us that, 5 is under the last, 50-year average, basically.
Correct. Yep.
Perfect. All right. Let's get to some questions here, and let's start to share. All right. So one question is about the HELOC. Can you just pull it out on primary residence or also on investments?
On the investments, they're a little bit more conservative. On an investment home, they're going to want you to do a fixed second mortgage, right? But I do have a product. It's a little bit more complex, but yes, I can get you a home equity line credit. Yep.
All right. And by the way, guys, home equity line credits on your primary residence in order to help you make more money. So it's something worth looking at. What does it mean when the seller says that they will carry a loan with minimum 20% down? Great question.
That's a great question. So what it means really is that the seller will finance 80% of the property's price. So if the house is worth $700,000, they'll finance as long as you put down 20%, which is $140,000, right? So they'll seller carry, and that's what Anna was talking earlier in our presentation today, that we're starting to see that. There's a lot of people that have a lot of equity and they have a lot of money out there. So rather than putting the money in the bank or the stock market, they feel more secure financing the home themselves. So that's
so the seller becomes a bank, basically.
The seller becomes a bank, correct.
Awesome. All right. Well, thank you very much.
I got a last question.
One question.
Yeah, somebody got me directly. Voltaire, would you mind muting real quick? Thank you. All right, cool. So the question that I got is somebody purchased a home, they got a conventional loan, but the terms of their loan is that it's got to be owner occupied. So they're saying, hey, when I sell, or not when I sell, but I want to keep this one, buy another one and rent out this one. Do I need to refi out of this original loan that I had because my terms were owner occupied? Or does it just stay as conventional? I go buy another one because my time has passed.
Great question. No, you don't have to touch that loan. That loan was at the time that you got the loan, you truly had the intention and you moved into that home. 12 months later, you can go buy another one. Whenever anybody gets an owner occupied loan, this is something very important for you guys all to know. When you're signing in front of the notary in the deed of trust, you're committing that you have the intention to occupy this home as your primary residence for the next 12 months, right? So as long as you occupy for 12 months, you can go buy another one owner occupied, Raul. Now, if you get transferred, relocated, you outgrow the place, there's been instances where 6 months later, I get that family out of that loan, they rent it out and they buy another home because it's bigger, they outgrew it, whatever it is. So yeah, you can go get multiple and you don't have to refinance your mortgages.
Perfect. Thank you. The last question somebody asked is seller financing safe to do? And yeah, it's safe. You just got to make sure your attorney handles. Yeah, you're protected with contracts and all that. So it's pretty safe. Perfect. All right. Thank you. Thanks a lot, Alfonso. Appreciate your time. And if anyone has any mortgage questions, just reach out to Alfonso directly. He'll put his information in the chat. All right. So now we go on to I'm Up, which is cool. So let me go ahead and share my screen here, guys. For those of you who don't know me, I'm Voltaire Lepe, CEO of Lepe Tendwell Properties, top 1% realtor in all of San Diego County. I've been in real estate for about 20 years now. And here's a quick resume. I own a lot of properties here in San Diego. I have 38 tenants. We need to update this resume. I have 38 tenants that pay me rent on a monthly basis. And I've done big deals, $11 million, small deals, $50,000. And I help a lot of families, hundreds of families here in San Diego over the years. So long story short, I have a lot of experience in the real estate business. All right. First, we're going to just talk about housing inventory. This month in January, we're almost 2,900 homes for sale. Last year, which was an anomaly, no inventory almost, there was only 1,400 homes for sale. So if you can see, we doubled compared to last year. However, a normal market here in San Diego, as far as inventory, the number of homes for sale is about 7,000 homes at all times Right now, we're only at 2,900 homes. So we're not even half of what's normal right now. So there's no inventory. If you compare it to 2008, back then there were 16,000 homes for sale. So there's a lot of people that say, man, and by the way, this presentation, what I'm sharing with you is so you could come up with your own opinion on what's going to happen with the real estate market. A lot of people are saying, man, it's a bubble, it's going to burst, and it's going to be like the Great Recession in 2008. Well, in 2008, there were 16,000 homes for sale. There wasn't enough buyers. There's oversupply of homes. And that's why sellers were just like, well, I can't afford my mortgage anymore. I need to sell. And that's why they were just dropping the price until it's sold. And that's why 2008, 9, 10, 11, 12, there's awesome deals back then. Buyer demand, it's the lowest since 2012. So there's very low buyer demand right now. And that's measured by the number of deals that are closing. Market time. Right now we're at 76 days on average it takes to sell a home here in San Diego, which is comparable to pre-coronavirus. So it's comparable to the years 2014 to 2018. It took about 70 days to sell a home back then. Remember, anything under 90 days is considered a seller's market. Anything under 90 days. So technically, we're still in a seller's market. Prices. The median price home, which is right in the middle, is $727,500. That's the median price single family detached home versus 12 months ago was $750,000. So we've had a 3% decline here. Some pockets more than others, of course. And now if you compare it to 2006 to 2007, so I went back to 2006, December 19th, and I went through January 19th of 2007. So 30-day span where there's about 2,100 homes that sold. The median price home back then was $500,000. Now, the reason why I'm taking it way back then is because I want to share with you, because 2006 was a peak of the real estate market back then before the bubble bursted in 2008. And then in 2008, the median price home went way down. So even people who bought in 2006 at the peak for $500,000, they held on to their homes. Now it's worth $727,000. Does that make sense? So they still made almost $250,000 in value, plus paying down their property for the last 15 years ballpark. Okay, so they made still a lot of money, even though they bought at the peak. Interest rates. Interest rates, Alfonso already touched on that, but they basically doubled over the last 12 months. And I'll just skip this part since he already touched on this. Now, this is interesting. Number of mortgages by interest rate. So here's the interest rate. You see it's 3% to 3.5%. I mean, sorry, 3.5% to 4% and 4% to 4.5%, 4.5% to 5%. And this is the millions of mortgages across the country. So when you do the math, guys, check this out right here is 24% of all households in America have a 3% rate or lower. 65% of all households in America have a 4% interest rate or lower. Why am I sharing this with you? It's because where are those sellers going to come from? That's a great question. Where are those sellers going to come from? Because right now we only have 2,900 home sellers. And if we don't get any more home sellers, then the prices are going to continue to stay strong. They're not going to drop like the rest of the country is dropping right now. But everyone has really awesome interest rates, really awesome monthly mortgage payments. So it's going to be really hard for some of those people to let go of their mortgages. This is a real estate cycle. Okay, so I just want to share with you how a normal real estate cycle happens. So in 2000, we came out of the recession, 2008, 9, 10, and we had a recession, right? And then there's a recovery phase. So all these years we've been recovering, declining vacancies, no new construction. And then there's an expansion phase, right? Declining vacancy, new construction. And then there's a hyper supply phase 3. And by the way, phase 3 hyper supply was in the last recession, Great Recession, was 2006 and 2007, when there's just so many homes on the market, right? 16,000 homes in the market in 2008. So there's increasing in vacancy and new construction. So they oversupplied the market back then in 2006, 2007. And that's why in 2008, it just crashed. And it was a recession. So now if we look at this real estate cycle that we're in, we've been in recovery and expansion phase, but we haven't hit the hyper supply phase where they're started building a bunch of homes and oversupplying the market. And as a matter of fact, right now, we're negative 35,000 homes in San Diego, up to 125,000 homes, depending on which study you look at. But either way, it's a huge number. And I'm showing you this because for the market to really crash, or a recession to happen, a huge recession in real estate, we would have to get an oversupply of homes being built, and that's not happening. Here's another real estate cycle, just it looks different, right? Recovery phase, expansion, oversupply, recession, bam. Again, there just isn't homes out there.
Voltaire, I have a question.
Yes.
If you may go back to the last slide, just I saw something interesting. Just because in the cycle you get an oversupply, then a recession. We're getting a lot of talks about the recession, but obviously there's not an oversupply. So does that mean that what's coming up and all of this talk of the recession, does that mean that it's not really going to impact real estate too much, if at all?
I would say that it's for sure going to impact real estate to some degree, because if there's a recession and people are making less money, or unemployment's high, they don't have jobs, or interest rates are high, they can't afford. Affordability is an issue. All that's going to impact real estate, but it's not going to make it collapse from looking at this real estate cycle, right? Because where is the inventory? So it's definitely going to impact real estate, but not to the level that it impacted it in 2008 when there was an oversupply of homes. Thanks for that question. So here's an equity.
Can I add something? And
Sure,
this is also nationwide. Like, it will affect another cities, but San Diego, it's a really interesting market because there's a lot of money, a lot of investors, and it doesn't get hit as much as other markets.
Yeah, correct. Exactly. A lot of cities across the country, they're experiencing price declines, just like we are, but a lot more advanced and a lot deeper percentage reductions that they're getting. So San Diego is, and we'll talk about that in a bit, but yeah, San Diego is definitely we're blessed to be here. Equity, okay, number of properties that are paid off nationally. 38% of all homes are paid off, guys. 38%, right? They don't have a mortgage, they're paid off. San Diego, 30%. So 3 out of 10 homes do not have a mortgage. Single family homes are about 24%, 2 to 4 units are about 35%, and then condos are 31% of condos are paid off in San Diego. Total equity, 48% of homes had at least 50% equity or more. Almost half the homes in America have 50% or more equity. 2.9%, under 3% of all homes are underwater. Those people don't have equity, negative 25% or more equity. And then 90% of homeowners have 20% equity or more. So why am I sharing this with you? Well, in the last crash, nobody had equity. Very low percentage of people had equity. So of course they had to sell for whatever somebody's willing to pay for the property. So right now everyone's heavy in equity, and 38% or 30% in San Diego of property owners don't have a mortgage on their property, which is, they're strong. So they're not going to give properties away. Rent prices, we're at 98% occupancy rate, which is awesome. That means 98 out of 100 units are rented out. There's only 2 vacant ones out of 100. Rents are, they're not jumping like before. They started to actually get under control. So they're not going that fast. But look at this. This is a 1-bedroom medium rent price across the US, and they list like the top 10 cities, and San Diego's there, number 6. $2,500 for a 1-bedroom on average. That's a lot of money. And that's what it is. You know, rents are up there, guys. And by the way, affordability. Alfonso talked about that for a bit. So if things are getting unaffordable because interest rates are at 6% and people can't afford to buy, what are they going to do? They're going to rent. They're going to have to rent, and rents are just going to continue to stay strong. Construction, the last, 2019, 2020, we built about 6,600 new homes. Compared to 2005, 2006, before that crash, 16,000 homes on average being built. So again, we're negative housing shortage, negative housing supply, 35,000 to 125,000 homes. So here's a quick overview. Here's some opportunities I see. Number one, borrowing money at less than inflation. So if inflation right now is at 8.5%, you're borrowing to buy your home at 6%, there's an opportunity there. Number two, ADUs, you have to invest in them. This is a quick rundown on how that works, and I'm going to touch on that more in a bit. But if you're building an ADU for $150,000, if you convert your garage for $150,000, and the average extra unit in San Diego costs $250,000, what did you just do? You just created $100,000 of equity for yourself. So that's a huge opportunity that I see. Three, once you rent that ADU out, you have someone else paying off your rent, your debt. So if anytime you could borrow money, guys, and have somebody else pay the debt off for you, you're in really good shape, right? Have somebody else pay off your debt, aka renters. So San Diego real estate market. So my best guess of what's going to happen this year is we're going to go down. Okay, the value of property is going to go down, but it's not going to go down significantly. 8.5% after 10 years of growth is not a lot. So where did I get this 8.5%? There's 27 leading research firms that all took a guess on what they felt was going to happen. Realtor.com, Home LLC, NAR, Freddie Mac, Mortgage Bankers Association, Zillow, Fannie Mae, all these big companies and their economists. And what I did was I averaged out the 27 responses that they had, predictions, and I averaged them out, and it came out to about 8.5%. So I figured, well, in San Diego, if a property is worth $1 million, 8.5% is 85,000. So let's say it goes down to 915,000. That sounds about reasonable, for something like that to happen, especially if interest rates, remain where they're at and things are unaffordable. So I don't think that's a huge hit, especially when other assets are going down and other cities are going down for way higher. The other opportunity is renters. You should never be renting. Owners will negotiate terms right now. And like I showed you the stats earlier, back, even people who bought in 2006 at the peak before the recession, if they bought and they held, they're still making money. It's a long-term gain for real estate. The last opportunity is what Amanda mentioned earlier, subject to, okay? Again, she mentioned creative financing. I'm mentioning subject to. So what's subject to? That's when you buy a property, it's creative financing. And like somebody asked earlier about seller financing, that's one opportunity. The other opportunity that's kind of like seller financing is subject to. That means that if, like, I'll just give you my example. I bought a property last year. That property I bought for $665,000, and they had a first mortgage on the property for $515,000. It was 3.5% interest rate, 30-year fixed. Awesome mortgage, 3.5% interest rate, 30-year fixed. I bought it, okay, but I didn't pay off the first mortgage, meaning I just took over. I took it subject to. I took over that property with the first mortgage, right? And I gave the seller the difference of the money. And all of a sudden, I started making those $2,700 a month payments to the bank, okay? So I didn't have to qualify for a loan. I didn't have to get the current interest rate, which let's say was 6%. I got it myself a 3.5% loan, and that's being creative. And that's what Amanda mentioned earlier, as far as an opportunity that she sees. And I feel the same. I think there's going to be a lot of more creative type of financing available this year. So that's my 10 minutes. What questions you guys have so I can answer them, and I'll go through the list. Does anyone have any questions here?
Feel free to unmute yourself as well.
Yes, feel free to unmute yourself.
Hi, it's Angela.
Hey, what's up, Angela?
Hey, I was just wondering, when you're saying that you're taking the home subject to, you have to assume, you have to bring in the amount of equity that they currently have in the home, right?
Yeah, whatever you negotiate. So in that case, I bought it for 665. I took on the mortgage of 515, so I paid the difference of maybe 150K or something like that.
Okay. So you would need
and-
150K in cash.
In that scenario, yeah, but then there's other scenarios, and then that's like a down payment, you know, how much is 20% on a property?
Yeah.
You know, that's on that same property, 20% is about 150K, 140K or something like that. So there's going to be opportunities for people that have savings for sure. But then you could try to get a better deal where the seller might require less of a down payment. Great question there. What other questions you guys have? Can you do a subject to on an investment property? Yes, you can. That's what I did. It was an investment property. Any other questions on the real estate market or anything that I just went over? If not, we'll go on to our next guest. And by the way, thanks for staying on. I know it's late. We're going to try to wrap this up in a bit. All right, so we'll go on to our next guest, and let me just exit out of here. Okay. Let me go down to where's Sarah? Might have to. All right, I got it. Okay, so our next guest is Abe Lopez. Abe, if you could unmute yourself and let me. Okay, so
Hi, everybody.
This is Abe Lopez. Hello. Abe holds a bachelor in architecture from Tecnología de Monterrey Campus, Guadalajara. Damn, it's just like a Mexican last name, huh? Like a bunch of names. And then
Everything is long over there.
And a master's degree in real estate development from Woodbury University. Abe Design Studio focuses on development projects as an investment. So Abe's an awesome guy. He's helped me with a bunch of my properties, not only the ones that I own, but the ones that I'm looking to buy. And he's the one that either talks me in or talks me out of buying a property, depending on the zoning and what's going on there. So he's an expert in the different rules here in San Diego and what you could build, what you can't build. So Abe, welcome aboard. What do you want to share with us today?
Okay, let me share my screen.
All right, go ahead.
Okay, and then here it is. Okay, as you mentioned, I have a bachelor's degree in architecture, and also I've been designing for 20 years. I used to be a contractor too, so I know a lot of construction, and I became a developer in 2010. And I've done projects for myself, multifamily apartment projects and housing. And also, I have an average of 35 residential projects a year, sometimes more, sometimes less, and about 5 multifamily projects a year too. We try to keep it low on multifamily because they're a little bit more challenging, but we love it. And what we basically do is help homeowners to make money out of their houses or investments, and to keep them. San Diego is really, really expensive, but at the same time, there's a lot of good opportunities. As you mentioned, Voltaire, rents are really, really high. We have a good team of designers, engineers, and architects that are of disposal for us, and we do something from a tiny remodel to just improve the quality of the house, either to refi, to sell it, or just to add an ADU to a large project. Our biggest project we have done is 255 unit building. We did it for another firm that they hire us to just do the whole project for them. So right now, one of the things I want to talk is construction cost. In the last 2 years, construction costs have been going up, especially during COVID. A lot of people started to remodel their houses, and labor has been short on construction. There's so many projects when the interest rates were low. A lot of projects were permitted, and a lot of people were super busy. And so that's one of the reasons that the construction costs went up. Normally, the time for construction is between 7 to 12 months. So we're going to see a lot of people out of a job in the next 10 months because once the interest rates went up, permitted stop. It slowed down a little bit. So there's not going to be a lot of new permits soon, and we're going to see a gap. So as you can see, the average price today is between 350 to 575 for new construction. That's depends on the finishes, depends on the type of construction, how many stories you're going to build. If you have fire sprinklers, everything changes. And I've seen really creative builders that they done something for $250 per square foot, or a remodel for $175. But it just is challenging because it's really hard to find the right people to do something right now.
Yeah, and by the way, the reason why he's going over construction and the cost and all that, because that's probably the biggest opportunity here in San Diego right now with all the laws that are in our favor. And there's a lot of property owners that are sitting on, 7,000 square foot lot and they're living in the 2-bedroom house in the front. Well, their backyard is worth a lot of money. And they just need to talk to someone like Abe to figure that out. And then at that point, they could say, wow, sure, I could build a little fourplex and I could get financing from the bank. Why not? Let me make money. So this is the whole point. And this is why he's going over construction cost of materials.
Yep. And one of the things that we see a lot is a lot of people, they think that they cannot make any more money out of the properties. And there's always room to improve your house, to have an ADU in the garage, to make another ADU in the back. And sometimes you can live for free. So if you find the right team, you can get that done. Now, the other thing that we see as builders is the prices for lumber and steel. So you can see here in 2021 and 2022, the lumber prices went up. One of the reasons was COVID. A lot of people stopped working and there was not a lot of supply. Now we can see the price have dropped dramatically. It's still going up a little bit because demand increases a little bit and everything changes. Like it's winter. There's not a lot of places that are cutting trees right now and processing trees is the main material that we use for housing. So it changes a little bit with time, but you can see that it's getting better. So when demand stops soon, because it's going to not stop, but it's going to slow down, we will see that price going a little bit lower. Now, the other thing that we see is steel. So steel is going up. Why? Because the war of Ukraine. So a lot of the steel that we get is from Russia, from Poland and other countries in that area, especially gas. And we need the gas to melt the metals, copper, aluminum, and steel. So we see the price of steel going up. It affects the foundation, it affects some of the parts, and it affects multifamily apartment buildings because they need more steel than a regular conventional house. So we're going to see the prices change a little bit in the next months. If interest rates keep going lower, people are going to be more willing to start building again. But we're probably going to see adjustments on prices for construction. Now, one of the things that we use a lot to get creative and create income is laws. So these are some of the laws that the city has passed to help us to make more units. As Voltaire said, we are 35,000 houses short in San Diego, and that's the whole county, from Oceanside to Imperial Beach, all the way to over there, Hamul and all that area. In San Diego, just the city of San Diego, we are short about 15,000 houses to 20,000 houses. So one of the things is the ADU. The ADU law have been changing every 3 to 6 months. So we have to be reading and reading. Just to give an example, the beginning of 2022 in San Diego City, we were able to build 2-story units attached next to the property line. Now we can only do a 1-story unit. We used to be able to attach 2 ADUs to each other in San Diego, 800 square feet each one. Now one has to be 500 square feet, and the other one can be up to 1,200, but they cannot be 800 square feet each one. So those kind of rules are changing constantly. So we have to keep ourselves updated on those rules. The other law is the SB 9. That's a law that allows us to do a duplex in any single lot and 2 ADUs. Now that law has some challenges. Some of the cities have charged really high fees, or they're making that law a little bit more complicated, so they don't allow you to do the 2 duplexes. But the counties, it's easier to do that. So that's another possibility. You can do 4 units in a single residence lot. That's really interesting. Then the second one is the SB 10. That's new law, just passed last year. The city of San Diego is gonna have the new rules by the end of the spring, and you can do 10 units in any multifamily lot, and that is in the transit priority area. Some multifamily apartment lots, you can only do 2 to 5 units, and this allows you to do 10. We don't know the rules yet.
Yeah, so just so everyone understands it is, so anyone who lives in City Heights, is this, by the way, is this City San Diego only or county?
The law is a state law,
SB 10.
but
Okay.
San Diego is the only one that has adopted it yet.
Okay, that has adopted it. Okay, so if you live in Logan, City
Golden
Heights,
Hill.
Golden Hill,
Yeah.
North Park, your lot, if it's multifamily lot, and before, like Abe said, you could build only 2 or 3 units or whatever, might not be worth it. You could build 10 now, which is crazy.
Yep.
So this is awesome, and we're running up against the time, but I'll let you continue.
Yeah. So but the next rule is complete communities. That's for same areas that you were mentioning. You can make a lot more units, like a lot. It depends on lots and everything. Now, this is a transit priority area. Those yellow circles are where all the transit priority area are. So be aware if your house is near one of those places, because the other rule that the state is passing is to basically not request any parking at all on those areas. So they're hoping that the city will become more pedestrians and more bike friendly, and they want to remove cars on the next 10 years from downtown. So one of the biggest problems that we had 6 years ago was to build something because the requirements of parking. Now there's a lot of properties, they do not require parking at all. And that's one of the things that helps us with the ADUs too. So developments, there's a lot of new developments that are happening. This one is in Chula Vista. This one is in downtown. This is Escondido. They changed the transportation system. And this one is Oceanside. So all these developments are basically going to change everything around us. They're going to provide new transportation systems. They're going to put more money in our city, and that will make San Diego better. So those one of the things that we have to take a look. Now, the other thing that we need to check is the accessory dwelling units. That's what the main thing that we see most of the time with homeowners. I think we're going to see a drop in the first year, 2023, because a lot of people are scared about the loans. You shouldn't be, because the rents are so high and the demand for units are so high. So if you spend a little bit more money doing an ADU, you will make it back easily. So we don't have the numbers for 2022, but this is just the city of San Diego. They permitted 871 ADUs in San Diego only. So we're probably going to see numbers between 600 to 700 units on 2023 in San Diego only. That's what I expect is going to happen. There's a lot of good programs for ADUs, especially if you do less than $200,000. Sorry, let me just check the number again. You can get a loan for $200,000 from the Housing Commission to do an ADU. If you make less than, I think it's $104,000 per year, and that's amazing. That's also great news that you can get a loan for really, really low interest rate, lower. That if you see in the bottom, it says like 1% of the construction loan amount.
So that's great. Anyone who has space in their yard or owns a garage, definitely look at this. I mean, if you're getting very cheap money from San Diego Housing Commission, it's a no-brainer.
Yep, it's a lot of paperwork, but it's worth it.
Cool.
So I put some things out. So the average cost for design an ADU right now is between $10,000 to $15,000. Depends on the size, depends on the complications, and depends on the existing house. A permit can be from $3,000 if you're converting a garage, the size of the garage tax, to $18,000. And construction, our average price that I've seen for a garage conversion is between 70 to 100. Sometimes can be 150, depends on the finishes, depends how complicated it is. And for new construction can be between $200,000 to $400,000 for a detached ADU. Those are basically the prices that we've seen recently.
Nice.
So this is
I'm
this is
glad
my
to see
information.
that.
I did it as fast as possible.
No, thank you. I'm glad to see on those that pricing that you're charging me double, which you charge everybody else, but appreciate it. No, those are all very good prices. Thank you very much. What questions does everyone have right now in regards to this? If you own a property, by the way, take down his information, because if you do own a property and you just saw this and you're like, well, maybe I could build something in my backyard, you can reach out to Abe and he'll tell you whether you can or not.
I have a question, Voltaire.
Okay.
Abe, so for new construction, that price that you put up, which by the way, I agree with you, Voltaire, those are great prices. What size of ADU for like 200,000?
I can tell you like between 400 to 600 square feet. Depends on the finishes. Depends if you're doing 2 stories, 1 story. It changes.
So it's like a studio or a 1-bedroom ADU type of, like, for 200?
Yeah. We had done 1 bedrooms for about 400 square feet. Yeah.
Okay. Awesome. Thank you. I'm gonna call you tomorrow.
Cool. Okay. Perfect. Thank you. Another question, Abe. How long to convert a garage on average from starting completion to including permits and construction, like everything from A to Z?
Okay, so that's another thing. Permits are getting faster right now. Normally, it was taking between 3 to 6 months to get a permit from the city. We've seen permits between 2 to 3 months now for a garage conversion. It depends also if the garage is, like almost ready to be done, or if we need to do some improvements like foundation or stuff like that. I always tell my clients between 3 to 6 months just to be safe. And the remodel of an ADU, I've seen people done it in 4 months for a garage conversion.
Oh, so it could be under a year from beginning to end.
Yeah.
Next question is, that's the same question. Do you work with lenders for construction loans? So I think what Abe does is he just does the design, he gets the permits for you, he gets everything approved, then he hands it to you, and then once you get that, you go and hand that to your contractor. Or if you need money, then you go to your bank first and then hand that to them, and then they're your contractor, right, Abe?
Yeah, there's actually, we normally don't work with lenders. We like, our network has a lot of lenders, but one of the things that we've seen in the past is we get you up to the permit process. So when you're about to pull the permits, you can actually go to a lender and show them the pre-approved letter from the city. You just need to pay the invoice, and they will lend you the money to pay the invoice from the city and start the construction. And also sometimes you get the money for the design too.
Oh, all right. Are permits easier or faster in the city than the county?
That's a tough question. Depends where in the county. For me, San Diego is easier. Everything is being done online. We set up meetings online. We show the projects online, and they're becoming better and better to do everything online. The county you still need to print the plans, go down there, check every single box and talk to a lot of people. And we just have to go back and forward with them. The city of San Diego just emails you all the comments. We can address the comments. If we have a doubt, we can get an online meeting. Each city has their pros and cons. For me, like Imperial Beach is super easy. They're super fast to review the plans and super fast to get you a permit. Chula Vista is really, really slow, slower than the county. La Mesa is really hard. El Cajon is okay. Which Oceanside, it's
Well,
okay.
let me get to the next question, because there's 26 cities in San Diego County. So this is a random question, but any tips for our youth aspired developers?
Okay, yes. Try to get a house, any house that you can afford, where there's a lot of work to, like nearby. For example, if you buy something in Barrio Logan, the rents that you can actually create from an ADU, or even sometimes we split a section of the house to create a JADU, are going to be safe. If you buy something that is really, really far away, the rents are going to drop. So try to find properties that are nearby where the work is, or where a university is. I've seen people that buy something in Jamul and they want to do an ADU, but there's not a lot of renters over there.
Yeah, question, Mom.
I have a question. Hi, Abe.
Hi.
For the ADUs, so you get the permits and the person that is doing the work, do they have to be licensed?
Yes and no. You can sign the construction as an owner builder, but all the liability is on you. You can hire a handyman, or you can actually be the project manager. You can hire all the subcontractors. You can hire the framer, the electrician, whatever. But all the liability, it's on you. And some of the lenders don't like that. Some of the lenders want a licensed contractor on record, so they can actually lend you the money. So I've seen that when you have savings or when you have hard money loans, you can do it by yourself.
So if, let's say that the owner, they have their own money, they're not getting a loan, you go and you get the permits, the people that are doing the framing, the electrical, plumbing, they don't have to be licensed.
It could be you. It could be you, Mom. You could do the electrical.
Yeah, they don't have to be
plumbing.
licensed. They don't have to be licensed. But if something goes wrong, it's on you. And I only recommend that if you have done construction before.
And the reason why she's asking is because she's thinking of having all her grandkids just build her a house in the back.
That's great.
Hey,
if you can save some money.
Yeah. Okay. Thank you for answering my question.
Okay, cool. Well, hey, thanks a lot, Abe. I appreciate you. A lot of good information. There's a lot of money to be made, guys, like for reals. And with this law, there's not a lot of people taking advantage of it. You guys have to go out there and just make money this way for sure. That's how I'm making money this year. All right, next.
Oh, I'm sorry, I had one last question.
Yes.
So when he mentioned the San Diego Housing Commission, he said the eligibility was if you had an income of less than, and then I missed what that was.
$104,000 a year.
Okay, and is that per couple in a household, or can it just be one? Or
I think it's a couple.
Probably household.
I'm not
yeah.
Right.
So
I'm not
you guys
100% sure.
You may or may not have to, break up with someone in order to meet that requirement. You guys figure that out. Next,
but you can file separately.
File separately. There we go. All right. Next, I have the pleasure of introducing Philip Simmons. And Philip has over a decade experience in the financial service industry and holds the Series 7 and 66 license. Philip earned an MBA in entrepreneurship and innovation from Point Loma Nazarene University. That's a great university, and a Bachelor of Arts in Economics from California State University, San Marcos. Welcome, Philip. I think the best compliment I could give Philip is, he manages money, and during this crazy time, he's got me even. I'm even. I ain't losing like all these other people. So I appreciate that, man. So what do you have to share with us today, Philip?
Hey, Voltaire, thanks for having me on, you guys. Good evening. I'm glad we were able to get this off the ground. I'm sorry that Zoom got hacked. It's pretty scary.
That's wild. Yeah.
Yeah. Well, yeah, guys, thanks for joining me.
And by the way, if anyone gets a text message saying, "Hey, this is Voltaire, send me some money or something," that's not me, okay?
Disclaimer.
Disclaimer, yeah.
So I'm going to try to make this as short as possible. Look at, market was a rough year. I'm kind of going to give, I told Voltaire when we talked earlier, I'm going to do the rear view mirror, talk about the cockpit, where we are today, and then we're going to look through the windshield where we're going. I have a little presentation I'm going to throw up here, and then we can get into some questions. So like Voltaire said, I got a decade of experience, been managing assets. I was formerly at Merrill Lynch, spent a couple of years there doing, the big corporate stuff. Got away from that. Now we're at a nice family office where we really take care of individuals and really plan legacies, multiple generations. So like I said, diving into here, what we saw last year, once this loads, we started 2022 off, great start. Came off 2021 was an all-time high. We were good going into the first day. Market was up 200 points. And then the worst happens. We were down 20% for 2022. A lot of that came in the beginning of the year. Like David Fogel had mentioned, Ukraine and Russia went to war, something that nobody could ever imagine. We had historically high inflation. Let me remind you that we haven't seen inflation like that since decades and decades ago, going all the way back to the 70s. One thing that you got to keep in mind for everybody on this call, keep your vision long-term. Just like you guys are investing in real estate, that is typically a long-term hold. It gets you value over multiple decades, over multiple years, whether it's cash flow or whether it's an increase in value. This is a chart of the stock market going back all the way to 1980. So I know we brought up interest rates all the way back to 1980. And look at this. If you stayed in the market, yes, there's going to be blips left and right, but that's what they are, just blips. Market returns on an average, any 10-year slice of the market, S&P 500 index returns 9.7% average per year on any 10-year slice of the market going back to 1929. Here's a great piece that I have from one of the companies I work with, Jackson. This shows you the positive and negative years that have happened since 1929. These color code in the top right gives you all the major recessions that we've seen or the depressions that we've seen. So like say, for instance, this dark color down here, oops, sorry about that. Dark one says the early depression from 1929 to 1932. That was a negative year of 43.3%, one of the worst times in American history. But look at the scale of how many negative years we've had and how many positive years we've had since the stock market was created in 1929.
So just so everybody sees, because I had a hard trouble figuring this out. So the red negative years, there's those years underneath it, and then the green positive years, all those years above it. Okay.
And they're broken down in tranches, and I can send this out to everybody. You guys can take a closer look, but I thought I'd share this with you. So kind of what happened last year. David Fogel had mentioned it. We hit inflation, a peak of 9.1% in June of 2022. Haven't seen that since the 70s. With that came the incredible Federal Reserve, this independent government entity that is supposed to be controlling our money. What they came in and did and said, hey, let's raise interest rates to slow everybody down from spending, because that's what continues to cause inflation. Just like your real estate agents have been talking about, and everyone then in the real estate field on the call has mentioned, rates have gone up across the board, whether it's auto loans, real estate loans, personal loans, even suppliers trying to buy supplies or forward contracts, future contracts, those rates have gone up. That has caused some slowing economic growth. We did see a recession. David Fogel pointed it out in the first and second quarter. We had negative GDP growth, constitutes a dictionary definition of recession. We fiscal and monetary policies, and then of course the global unrest. It wasn't just Ukraine and Russia going at it and going to war, but you got to remember the other side of the world in Asia, where we had this unknown COVID epidemic that was still going on in China. We had overcome it quite well, but China was still dealing with it at a great magnitude. Okay, let's get this to the next one. There we go. So this is what the indices, these are the major indexes that we have in the United States. The dark blue line is the Dow Jones, considered more of a value play. Companies that have been around since 1929. Think of yourself like Coca-Cola. I'm sure everybody pops one of those and when they're watching the football games. The S&P 500 is in the yellow line. That's considered more growth. It has the top 500 companies in America. They do rotate. They have to meet certain credentials to be in the S&P 500, but you can see that was down 19.4, right on the heels of that 20%. And then there's our favorite, the NASDAQ, which is tech heavy. So think of all your high flying tech companies. Think of all the new tech companies that are coming out with virtual reality, space exploration, space tourism, any of those that are cybersecurity, any of those that are actually getting started or have maybe a small history of 10 years are found in the NASDAQ, and you can see how well that did last year, down 33%. So David Fogel pointed out on his charts, but I thought this was a bit of an easier summary to look at. The trend was down. Even the recovery that we saw in Q4, where the market was up something like 7% on the S&P 500, 15% on the Dow, wasn't enough to erase all that had happened through last year. 9.1% inflation. We have come down to 7.1 in November. And as of the CPI number, that's the Consumer Price Inflation Index of last week, we're at 6.5. So you can think in a 6-month time frame, we've gone from 9.1 to 6.5. It is going to prompt the Federal Reserve to be less aggressive this year. Now, not to say that they're not going to raise rates. They just may do it at a slower pace, or they may even take a moment to pause and see what the market does. Remember, the CPI is a lagging indicator. So it's telling us what has already happened. The market, the financial markets, the S&P 500 index, the Dow Jones, the NASDAQ 100 are leading indicators. They're typically going to give you a reading of what's going to happen 30 to 60 days ahead of schedule. So here's an inflation. I don't really like this picture, but I took this the other day. These are inflation across the board. So when you're going to the grocery market next time, take a look at your budget. You're paying almost 50% more on eggs, 34% more on butter, 19% on lettuce, bread. Look at milk and poultry. We haven't seen this historically. So it is one of those things that that economists are still having to struggle with when we're having low unemployment, creating jobs, but we're having inflation that's was nearly 10% at one point. Interest rates, as you know, have gone up to between 4.25% and 4.5%. That's the federal funds rate. I think Alfonso alluded to it. There's not a direct correlation between what the federal funds rate is and your mortgage rates. Typically, banks will follow that to a certain degree, but not always. I think he mentioned that rates actually have been coming down a little bit. So you may likely see that continue as we go into the second quarter of the year. But right now, 4.25% to 4.5% is the federal funds rate. I want to talk about bonds today. One of the things that I just want to say, hey, now going into the new year, just proceed with caution. We're cautiously bullish here in the office. We know that there's money to be made. We know that things go up and down in the stock market, but if we can position ourselves with good companies long term, we're likely to see value increased over time. One of the things that we do expect are more interest rate hikes. Like I said, they're not going to be as big as 3/4 of a rate, but they may be something like 1/4%. And that could happen February and March, and then they might slow down. Borrowing costs are obviously going to continue to be high. And that's not just on a consumer level, that's on a producer level as well. So those raw goods and those raw materials, borrowing money to buy those goods to create the products that we all are buying is still a cost that they have to incur that they're passing down to us as the end consumer. One of the things that you want to be mindful of, all of the assets that are producing income, including your real estate portfolio. Be very mindful of how you're getting that cash flow, because at the end of the day, one thing that I can tell you in all the experience that we've had in our office, simplicity and cash flow are king. Keeping your portfolio simple, keeping the cash flow on a positive note is really what's going to make for long-term growth. And then lastly, look at practice patience. I know we all want the get rich quick scheme. I know we see the Bitcoin that jumps 30,000 points or $30,000 in a week. But you also see how Bitcoin has crashed. You also see how the fraud that can be behind things like that. Be patient, keep your focus long-term, buy companies that you know and well. I always tell everybody, look down at your shoes. Are you wearing Nikes? You might want to go out and buy Nike stock. If you shop at Walmart, you might think about buying Walmart stock. These are things that you want to keep in your long-term focus.
Ooh, thank you, man. To the point, precise. That was good. The outlook. You're still going with the outlook. Okay.
Just real quick. One thing I want to show you is if we go into a recession, it is most likely going to be mild, like David Fogel pointed out last year. Quarter 1, quarter 2 were mild recessions. But here is how the stock market grows after recessions. So if you look at the 1 year after recession, you're likely to see somewhere between 5 and 9% growth. 2 years after recession, 11 to 19% growth. 3 years after recession, 30 to almost 40% growth in the stock market. So again, keep your perspective, keep your focus long-term. As we look forward to the rest of the year, bear market is continuing. David Fogel pointed out on the technical charts. One thing that I am big on, just revisit your budget, determine what's necessary, find where you can strip out cash to get invested into the market. Because I can tell you, we may not see these lows again. And this is a very good time to position yourself in the market long-term. Have a financial plan tailored to what you do, to what your business is, and specifically to whether your real estate goals or your future goals are. You can't plan for something if you don't know where you're going. I tend to proceed with caution. And if you have any questions, Voltaire knows how to get a hold of me, and we'd be happy to help.
Cool. Thank you. If you want to put your information in the chat, go ahead. And that way, if anyone has questions, they can reach out, or you guys can reach out to me, and then I'll make the introduction to Philip. Thank you for that information. And we're almost up on time, but we do have one last person, AJ. AJ Gupta, are you there? And thanks a lot, Philip. Appreciate you.
Yeah, I'm so sorry for being late, Vol. I appreciate you guys
all good.
kind of scrambling around me.
It's all good. So this is AJ, or Mr. Gupta, sorry. Super lawyers between 2015 and 2018, which is reserved for the top 5% lawyers in the country. In addition, Mr. Gupta is one of 14 certified bankruptcy specialists in San Diego County and widely regarded as an authority in the area of real estate and corporate law. You know, I asked AJ to pop on today just because he has the unique experience of dealing with people who are going through bankruptcy. So he's seen people, you know, he has a good understanding of the flow of what's going on with people and their finances. Also, he does real estate law. So he sees what's going on with the different laws. It's, you know, whether it's tenant, landlord, or others. So AJ, you got the floor in about 10 minutes. So whatever you want to share with us, that's going to help us make some money this year.
I'll try and keep it real. There we go. Okay. So I'll try and keep it real brief and topical. So just, you know, broadly speaking, when I look at the real estate market, I'm looking at a few things. I'm looking at the amount of litigation that we're seeing, right? That's usually a good indicator of what's going on. I'm looking at the number of foreclosures that we're seeing. I'm looking at the number of bankruptcies that are filed, and I'm also looking at landlord-tenant issues. So, you know, I think landlord-tenant is where I'd like to start, because what we've seen over the last, you know, 12 months has been a tremendous amount of change in San Diego County with landlord-tenant laws. And so there's recently been in San Diego this right to housing mandate that's been passed. There hasn't been any substantive legislation that's come around that, but what we had seen prior to, and I want to say it was September, October of last year, what we had consistently seen was this anti-eviction or slowing down of eviction processes that were tied to COVID. And you know, from a landlord perspective, you're always asking yourself, well, geez, you know, what's going on with some of these laws when we know that really almost everybody has a job right now. So how do you get to say, on the one hand, look, COVID is affecting renters' abilities to pay, and we're going to pass this legislation that's going to make it very difficult to evict, and on the other hand, nobody can find employees because everybody's got a job. And so there's this natural contradiction that existed in the marketplace for a long time from a landlord perspective. And it wasn't until really September that they said, hey, look, we're going to put an end to that circus. We're going to allow evictions to move forward. And what's happening now, on a day-to-day basis is you're seeing the evictions are still taking a lot longer than they used to, but they're actually working their way through the process. And you are seeing certain things that the legislation, the city council for San Diego's passing, that is really slowing down the process or making it more difficult. I think most of us understand there's the right to know ordinance. There's a couple other state ordinances that are preventing landlords from just evicting or from controlling their properties. And really what they're trying to do is change the dynamic for home ownership as a landlord to make it more tenant friendly. And really, I mean, and they don't say this expressly, but what they are trying to do is promote primary residence ownership, because what happens in the marketplace is you have a situation, and especially in major metropolitan areas, the more urbanized you get, San Francisco, New York being the worst examples, you start seeing home ownership rates decreasing. You'll see like 20-30% in San Diego, San Francisco, in Manhattan type areas. San Diego's typically in LA are about 50-50, but nationally you'll see about a 70% home ownership rate. And what you start seeing is landlords are really driving the cost of housing higher because they make such good investments. And so some of these rules, while not explicitly stated, are designed to make it less friendly for landlords to make money. And so in these environments, so that to promote home ownership, primary residence home ownership, to drive that population out and effectively drive housing rates down. And so I think you're going to see more and more of that moving forward in San Diego County in particular, even if it's not stated explicitly. So just be prepared for that. Interest rates have an impact. Switching gears to litigation, interest rates have an impact on litigation. Typically litigators get busier, which is what our firm is and what we're seeing in the marketplace, when people have to hold on to properties longer. If you come into a project, you think it's going to take 6 months to build the project and $100,000 to improve the property, right? And then it's going to sell in 3 months. Suddenly, that 100,000 is 150. But when you have a market that's been going up as steadily as it was going up, then a lot of that off, whether it was how long it took to do the construction or how much it cost, gets buried in the increase in housing pricing. And so when you don't have the ability to buy your way out of a project through the unexpected increase in the housing prices, that's when the investor says, hey, where's my 100 grand? Oh, I don't have it. And suddenly that's the source of friction in litigation. So we are seeing that uptick in litigation because of two things. One is houses are staying on the market longer because the market isn't there for the buyers. And you guys know this firsthand. I'm preaching to the choir when I talk about this stuff. And housing prices are stagnant or deflating now. And so, what was a project that was supposed to sell, you put in 500 to buy the property, 100 to fix it up, and it's worth 750 on a flip. Suddenly that equation isn't there because it costs 150 and it's only worth 700. And that's what triggers the litigation to happen at that point in time. And so because of the length of time that people are holding the properties, the cost of money increasing and the decrease in property, we are seeing an uptick in litigation. So you're seeing those two things happening. Now, as far as foreclosures go, we're not seeing an increase in foreclosures from the main banks, right? We're just not seeing it yet. I don't know if we will see it down the road. I know a lot of people refied into great 30-year fixed rates, but I'm not seeing it in my practice at this point in time. I'm expecting to see it, but where I am seeing it is in two major areas. I'm seeing it primarily in hard money loans. We're seeing those projects that I just talked about, where the hard money loan, it's taking longer to develop the project, it's taking longer to flip the project, and we're seeing a lot more, and that's driving a lot more of the bankruptcies that I'm seeing. So, so the hard money loan is one, and the other one, which I wouldn't have expected, but it's a lot of reverse mortgages. So whether that was pandemic driven or just, you know, senior citizens not passing or passing away, I'm seeing a lot of foreclosures on reverse mortgages, which to me signals like either people passed away during the pandemic and now they're getting around to foreclosing on those properties because the people don't want to sell them or handle them through probate correctly, or it's just a unique coincidence. So I am seeing a lot more of those properties where maybe the estate plan isn't in place. At least in my mind, I'm envisioning a situation where somebody had a reverse mortgage on their house. The person passes away and there's no heirs in the estate. And so that's causing the bank to have to go and foreclose on the property at that point in time. So that's the other area that I'm seeing an uptick in foreclosures. And if you've ever sat with me in a room before, I'll always say this about bankruptcies being the last area that I wanted to cover. Bankruptcies are always a lagging indicator of what's going on in the marketplace. Typically what you see is people will run into an obstacle, they'll beg, borrow, and steal, they'll wait till they're sued, they'll get the judgment, and then they'll file for bankruptcies. So when you look back, you know, historically, you know, the peak of bankruptcies during the last crisis, it wasn't 2007 and 8, it was really 2012 and 11 and 12, you know, and that's worth talking about a little bit. So, and I'll be quick with this as well. I know I'm throwing a lot of data at you guys, but you know, 10 minutes goes by quick when you're covering ground like this. So, you know, to give you an idea, 2012 in San Diego County, there were about 20,000 bankruptcies filed, right? The historical average for an area like San Diego was about 6,000 to 7,000 bankruptcies. So if you're looking at that correctly, you're saying, look, that's, you know, and I'm looking at the data right now. Actually, it was 2011, there was 21,000 bankruptcies that was filed. So that was the peak. And that was about 3 years after, you know, the peak of the crisis. If you think about it, the crisis really was maybe 2008 was really when we bottomed out. So, and again, it shows that lagging indicator theory that I'm talking about. Fast forward, you know, 2015, 16, 17, and 18, we're back to kind of historical averages around 8,000 a year. But then you hit the pandemic, and the bankruptcy court didn't stop at all during the pandemic. What did stop were lawsuits. What also stopped were foreclosures. So, and that was, let's just call that 2020, 2021. Bankruptcies dropped in 2020 to 6,300 and 5,000 in 2021. And last year in 2022, that was an all-time low since I've been practicing of 3,300 total bankruptcies filed in San Diego County. And that's astronomically low. I mean, that is a very, very low number. And I'm going to spot check that because I think this data, this website is a little bit old because I can spot check that on another.
But either way, your business definitely, as far as BKs, went down in 2022 because there just wasn't that many.
Yeah, and I would say the bulk of our practice is litigation anyway, litigation and transactional work. So it doesn't really impact me directly as much. But at the same time, it's just a good thing to have and a good thing to understand. That is right. 3,300 was right. We filed a bankruptcy on December 26th, and that was around 3,300. So that's the correct number.
Okay.
Surprisingly. So yeah, that's an indicator. And again, I think we covered this last time, but there was just a ton of money that was pumped into the economy in 21 and 22. I mean, in 20 and 21 in particular, and even through 2022, there was just so much money available to folks, and there was so little actual foreclosure, eviction, and credit card collections work going on. All of those things work together to drive down the number of bankruptcy filings, but okay. I am expecting them to pick up, but there's not much you can tell from what happens there.
All right. Well, thanks for all that information, AJ. I know it's late. Last thing, what's your crystal ball? What do you think is going to happen this year with the economy or real estate market or anything?
Well, I think this is new normal for a while, right? And I don't think that's necessarily a bad thing, quite frankly, but I think this is new normal for probably 2 years. I think we move sideways for a while, and then until there's an excuse to drop interest rates again. And I think, you know, it's going to be like, oh, I stubbed my toe, let's drop interest rates to 0. And then that's when we're all going to get off our ass and do something. So.
All right, cool. Sounds good. Any questions for AJ before he jumps off? No? All right. AJ, thank you. Everyone, thank you for staying up late with us. I know it's been a long night. We got hacked twice. But we're all here, worked out. Thank you very
We got
much.
hacked 3 times.
3 times. Yeah, I'm trying to just downplay it right now. I'm just trying to forget about the third one. Hey, if you guys have any questions about any of these topics that we discussed tonight, reach out to us and then we'll introduce you to the right person to talk to, whether it's AJ or Abe or anyone else. Thank you guys. Have a good night. Peace.
Thanks, everyone.
Bye, thank you.